Hello, everybody, and welcome to our show today. So today we're going to be diving in. We talk a lot about business credit. We talk a lot about financing. But this is the first time I've ever done anything talking about how to make a profit and loss statement, what a profit and loss statement is, what you need to know, these type of things. And the reason I decided to do it is because I do a lot of live webinars, live streaming webinars, etc., on topics that people are asking about. And now that we're just starting the new year, we get a lot of questions about P&L because people are getting their taxes done. They're starting to work a lot with taxes, have a lot of questions related to taxes and P&Ls and balance statements and all these type of things. So I just thought it would be a great topic to dive into. The bottom line is, if you're going to work with lenders, if you're going to come in and try to get business loans, you need to know the information that we're going to be talking about today. It becomes very, very, very important to do so. So before we dive in, let me introduce myself. My name is Ty Crandall. I'm actually the CEO here at Credit Suite. And what we do at Credit Suite is we help people obtain business credit, obtain all different types of business loans. So we deal with P&Ls all the time because a lot of lenders, especially if you're looking for longer term loans or you're looking for lines of credit, are going to want you to have a profit and loss statement done. So what is a P&L? What is a profit and loss? Well, first of all, P&L is just short for profit and loss statement. And you can see right here from Investopedia, according to Investopedia, it is a financial statement that summarizes the revenues, costs, and expenses incurred during a specific period of time, usually a fiscal quarter or year. These records provide information about a company's ability or lack thereof to generate profit by increasing revenue, reducing costs, or both. The P&L statement is also referred to as a statement of profit and loss, income statement, statement of operations, statement of financial results, and income and expense statement. Now, in my world, I see P&L oftentimes referred to as an income statement. So those are the two most common ways that you're going to see a P&L. Now, again, this may seem like a really boring topic, but the reason I decided to cover it is because profit and loss statements, how you make a profit and loss statement, can absolutely determine whether you get denied or approved for a business loan. Not just a business loan, the business loans you want, lines of credit, term loans with longer terms and lower rates, SBA loans. They're all going to be asking or want to see these P&Ls. So getting them done right really does determine the difference between an approval and denial. So again, the P&L, the income statement, is one of 3 quarterly and annual statements that a company basically makes to show its financial health. The other ones you may be asked for, or a cash flow statement or a balance sheet. These are the things you mainly need to know. When it comes to getting a loan, they're typically going to ask for one or multiple of a handful of things. Tax returns are one, a profit and loss, or what they'll refer to as your income statement two, a cash flow statement, or balance sheet. Typically, balance sheet, income statements or profit and loss statements, and tax returns are the most commonly requested income documents that you'll see from lenders. Now, numerous blank P&L forms are available online to help. You maybe want to take a screenshot of this one. It's one of the best ones we found at view.officeapps.live.com. If you go to view.officeapps.live.com, and there's a much longer URL that I have listed here, you can come in and you can get a pretty good P&L statement. But again, if you Google how to get a blank P&L statement, you could do that as well. There's also a lot of companies out there that work with all kinds of forms where you can get access to them. So what does a P&L show? Well, the idea is to basically show changes in your accounts or in your basically profit, expenses, etc. over time. It's a specific time frame, as we've mentioned. And that way, it's similar to a cash flow statement. But contrast this with a balance sheet, which is more of a snapshot. So a balance sheet is kind of your existing balance, how much cash you have on hand at any given time, whereas a P&L is a historical account of where you've been over time and how things have changed. So why do you want a P&L? Why should you care? Well, outside of the obvious one that someone asked, and someone is usually the lender that's going to ask, you also need them because it gives you a good handle on the money your business has. You know, a balance sheet might show you the cash you have on hand, but a profit loss statement is absolutely telling to where your money is coming from and where your money is going. Where are your revenues coming from and where is your money going in regards to expenses? So I watch a show called The Profit, and When we interview our clients, we find this is one of the most popular business-related shows that they watch, even more than Shark Tank. And the profit, he looks at what he uses to make the determination of how much he's going to pay for a business. I mean, literally, it is the main factor that he looks at to even make a determination of to buy a business or not. Because a P&L statement will tell him how much money is coming in, what sources the money is coming from, and also where the money is going. And if you know those two things, you have a pretty good grasp overall on your business. You need to know how much capital is coming in, and you need to know how much money is going out and what these things are. If you feel like your business is making a lot of money, but you don't have a lot in the bank, well, then your P&L tells you where the money that's coming in is going, so you know potential expenses to cut, so you have a good idea of changes you may need to make to keep more money in the bank, for example. So you want to start when you're making a profit and loss statement. The good thing I'm going to show you here today, I'm going to show you what this physically looks like on an Excel log as we go. So I'm not going to just talk about theory. I'll show you what it looks like, because that's the way my mind works. I'm a visual person. You can tell me about how to do something all day, but when you show me physically how it's done, that's how I absorb the information. So a P&L starts with what's net revenue, or the top line revenue. This is money coming in from sales, money coming in that you're actually charging customers money for and collecting money. You subtract what are called COGS, which become very important to your business as you grow. Cost of goods sold, your expenses, your cost basically. And this is a hard cost associated with producing your product or service. So you've got your net revenue and you've got your cost, and those cost of goods could be materials, equipment, anything that's designed to produce your actual revenue, right? So in our case, for example, we are software, right? So we have a software system that we offer to our clients that helps them build business credit and get loans. So our software costs are obviously part of our COGS, for example. So here's what it looks like on a real Excel log. You can see the top section here is for revenue, net revenue. We can see the middle section of cost of goods, or what's called COGS. And we see the bottom is the gross margin, okay, which basically is what's left over. So in this current example, we have the current period, the net revenue is $5,000 in sales. And we see here the cost of goods, the cost it takes us to make the product or service to sell to make the $5,000 is $1,500. If we subtract the two out, boom, there's your gross margin. Again, I learned better by seeing this. This makes a lot more sense to me than the previous slide that I just showed you. So your gross margin is what's left between the two. Before your actual operating expenses, subtract your fixed expenses. Now, these are fixed regular expenses like insurance or rent. So a fixed expense is something that's not variable. It doesn't change. So we're in an office here. We have insurance we pay every month. We have rent we pay every month. So fixed expenses are expenses that never change. They stay fixed versus being variable from time to time. So here we go. Now what we're going to do is we're looking at these fixed expenses, and we see that the fixed expenses are the rent. $1,500 is the actual fixed expense. We see here that the total of the fixed expenses ends up being $2,000. The earnings before taxes basically are $1,500. So all we need to look at here is we're subtracting out the actual fixed expenses. So you want to subtract your variable expenses, which are just what they sound like, right? Changing expenses, traveling, marketing, things that change from month to month. And this is what's called EBT, or earnings before taxes. Now, this is what you have before taxes are taken out. And ultimately, in a lot of cases, this is what valuations are closer to being actually looked at. So if you're looking to see how much your business is worth, well, that's called EBITDA, and it's very close to this, your earnings before your actual taxes. So here's what we look at. Here's variable expenses added in, right? $500 for advertising, because that changes month to month. So this is a variable expense versus the fixed expenses that we looked at. Now you're going to subtract your taxes. And again, we're kind of looking at this in order, right? So if we go back, we first started here with just writing out our revenue, what our revenue is. But then we started with our cost of goods. Those are the cost to produce the actual item, right? We got our gross margin of what's left. We've got our fixed expenses we've subtracted here. We've got our variable expenses that we've subtracted. And the next thing we're going to do is taxes, right? These are expenses you got to pay. You got to pay the IRS and taxes. You're going to be in some serious issues. So the amount of which is left over is your net income. This is the bottom line money that is left after everything else that's an expense, everything else that's a cost is actually deducted. So this will show if your company's profitable, losing money, or breaking even. So we looked at how much money we made. We subtracted the cost of goods sold, the cost to actually make that product or service. Then we looked at expenses, which are kind of necessary to keep the lights on per se, but not necessary to producing the actual product, right? So for example, having an office here that we're in doesn't help us make our actual product. It's not a cost of goods for us because we're still going to have our software, whether we did have the office or whether we don't. Our development team doesn't even work out of the office here. So we subtracted our cost of goods sold, the things involved with developing our software, for example. Then we subtract out the actual fixed expenses, our rent, and the things that are fixed that never change from month to month. Then we actually subtract out our variable, our marketing, our advertising, anything that we pay that changes from time to time. Then we subtract out the actual taxes that we're going to have to pay. And what's left over is our actual net income. This is the money after we've subtracted everything that we have to pay is left over. And this is either going to be a positive or it's going to be a negative number. If it's a positive number, well, then our business is profitable. If it's a negative business, then a negative number, then obviously our business at that point is not profitable. So it's important to compare P&L statements over time because profits can rise and can fall. And this is why you may look at one quarter and say, whoa, we made really good profit. Then the next quarter, you don't make as much profit. You want to know why. Okay, I can tell you I'm not a real big numbers guy. Although I love math and I love financial services, when it comes to all the statements and the financial accounts of the business, honestly, it bores me. But I can tell you that I have to know it. It's my responsibility to know it because if we don't have a bunch of profit left over from one quarter to the other, I need to be able to pick up a P&L, so do you, to know what's causing that. I may look at it and go, we crushed it. We made a bunch of profit the first quarter. We didn't make as much profit the next quarter. Why didn't we make the profit? Well, the P&L shows that we spent a bunch of money in developing our software during that quarter, and that would answer my question. But it would only answer my question if I knew how to read a P&L and compare them from one to the other. So profits can rise and fall. Variable expenses will vary. Sometimes they're higher, sometimes they're lower. If profits are going up, but so are costs, then the bottom line might remain the same or less the same. So there's a lot of variables here. But you won't know that without the detail inherent in a P&L. And this is why you get a P&L statement, because you need to know these things. Okay, as costs vary. And this is something we look at all the time because we go through every quarter and cut expenses. We look at every expense on our P&L, and this is a great lesson for all of you that own businesses. And what we do is we call a lot of the companies that we have expenses with, and we ask them to reduce the expense. You'd be blown away at how much money. Every time we do this, we literally save thousands of dollars a month. I'll give you an example. We called our software CRM provider, Infusionsoft, and we said, hey, you guys account for one of the largest expenses we have a month. It was like, I don't remember what it was. It was, I don't know, $1,400, $1,500. And what we want to do is we want you to investigate to see if there's a way for us to lower the expense. And they said, okay, no problem. We'll look into it. They got back to me the next day and they said, you are paying individually for every user you have in the business. And we actually have group user packages where you could buy a bundle of users instead of paying. How much does that save us? $40 per user. When it was over, we saved $700 just by calling them and asking what we could do to lower our expenses. So we learn our lesson, and every quarter we go through our P&L, we look at our expenses, we call the people we have expenses with, we ask them if we can lower the bill. Okay, we do that with our cable provider. We go through and say, our internet's pretty expensive. We just got solicited by Verizon, who's your competitor. They said they can beat it. What could you do to help us? Because it makes no sense to stay with you and pay you more than Verizon. And then in a lot of cases, they'll come in and make some changes on our account and lower the expenses. So it's good to have P&Ls. It's also good to review your expenses and call a lot of the people that you have expenses with, because in a lot of cases, they'll lower it just because you're asking for an audit or review. So what else can you use a P&L for? Well, one thing you can do is calculate the gross profit margin. We looked at this earlier. This is the company's total revenue minus the actual cost of goods sold, or the COGS. So divided by, again, don't get lost. I'm going to show you what this looks like here. Divided by total sales revenue, and it's simply expressed as a percentage, okay? And we'll talk about that, actually show you that in a little bit as well. So basically, you're taking your gross profit. This is the company's revenue minus whatever COGS were, and we looked at that very early on, the very first slide I showed you. We divide that number by the total sales revenue, and that's expressed as a percentage. Now, we actually looked at this earlier when we looked. I'm not going to go back on the very first slide that I showed you the actual Excel log breakdown. So this gross margin number represents the portion of each dollar of revenue that a company keeps as its gross profit. If a company's gross margin for the most recent quarter is 45%, then that means it retains about 45% from every dollar generated. Pretty simple. The company spends the rest as COGS, which is your cost of goods sold, right? Because your cost of goods sold have already been taken into account. Remaining funds can go into paying off debts, general and administrative expenses, interest expenses, any distributions to shareholders, those type of things. So again, figure gross margin with this equation. Your revenue minus your cost of goods sold divided by your revenue. That's exactly what it is. That's exactly what your margin is. It shows you the percentage of real profits that you're actually retaining. Now, P&L can also be used to calculate a business operating profit margin. Operating profit margin is a margin ratio, and it's used to measure a company's pricing strategy and operational efficiency. It really helps you determine, are your prices right or not? This is why you need to know this, because most of us randomly just decide and choose a price with absolutely no backing that we're going to charge. Maybe we look at other people in our field. Maybe we just make it up. Well, this gives you a statistical and mathematical way to figure out what your pricing strategy should actually be. And it actually looks at your operational efficiency as well. If your costs are way too high to produce the actual product or service, well, that could be signs that you're actually inefficient on the operational side. So it's a measurement of what proportion of whatever of a company's revenue is left over after paying for variable cost of production like wages, raw materials, and the like that. That's what that actually gives you. So it's a really good margin to know kind of what's involved, especially with the operations of the business. Now, an operating profit margin is calculated by dividing the company's operating income, basically its operating profit, within a period by its net sales during the same period. Again, I'm going to show you what this looks like. So operating income refers to the profit which a company keeps after removing all the operating expenses like COGS and wages and depreciation. Net sales means the total value of sales minus the value of returned goods, things that get returned to you, cancellations, etc. Any allowances for damage, missing goods, discount sales, those type of things. So the equation looks just like this. Your operating income divided by your net sales. And that's what will give you the operating profit margin. Now, your profit margin is a portion of a category of profitability ratios calculated as net income divided by revenue, or net profits basically divided by sales. So let me explain what that means. Net income or net profit may be determined by subtracting all of your expenses, operating costs, materials, tax costs. Basically, you're subtracting all of that to basically get to your net income or your net profit. Now, profit margins are shown as a percentage, and they effectively measure how much from each dollar that you make, you actually keep in earnings. Pretty important, right? You want to know for every dollar you charge, you want to know how much of that you actually keep. Well, that's exactly what this is. So a 20% profit margin, therefore, means the company has a net income of about 20 cents per dollar of total revenue. Very important. If you ever watch a show, Shark Tank, they always ask this question: what's your profit margin? They want to know exactly what I'm actually telling you how to do right here. They want to know what your actual profit is. They want to know what percentage you actually have of every dollar that you sell, how much of that is actually left. So net profit margin is the ratio of net profits to revenues. It's your net profits, how much you basically have left over compared to the revenue for a company or business segment. So it's often expressed as an actual percentage. Net profit margins show how much of each dollar exactly that I just kind of showed you translated into profit. And here's what that looks like. Your net margin equals net profit minus revenue. Okay, so that's actually how you're going to come in and develop your net profit margin. So operating ratio shows the efficiency. We're talking about a lot of different ratios, a lot of different percentages, because you're going to be exposed to them. You should at least roughly know what they are. And if you're not keeping notes, you can keep this video to go back. So as you're learning a P&L, these things will make more sense. And when you're looking at your own business P&L, it will definitely make more sense. So an operating ratio shows the efficiency of a company's management. It does this by comparing operating expenses to net sales. So the lower the ratio, then the greater the organization's ability to generate profit if revenues go down, okay? So that means that the greater operating ratio you have, the more you have the ability to still make profit even if your revenues decline. So when using this ratio, investors should note that it doesn't take debt repayment or expansion into account because those don't deal with regular operating expenses. So operating ratio measures the operational efficiency. It's often used with return on assets and return on equity as a measurement of a company's efficient use of capital and managerial resources. And tracking the operating ratio over time allows for the identification of trends in operational efficiency. And that's what you're looking for. When you look at this over time, then you're basically getting an idea of what your trends in your efficiency are. And that will help you determine whether you should become more efficient or basically less efficient. So trend analysis can help to identify issues and allow for timely course corrections when you monitor this on trends. And this is what's nice about P&Ls. P&Ls won't just give you a snapshot of where you are in time. They give you trending data that's taking place over many quarters or many years. And then based on those trends, you can make course corrections, whether to improve or to make changes to basically improve. So a rising operating ratio means an inefficient operating environment. You may need to implement cost controls to improve your margin. So a falling operating ratio means an efficient operating environment. It has operating expenses, which are increasingly a smaller percentage of sales. And that's what you want, right? And here's the idea of this. And this might not all make sense, so let me kind of map it out. The way to think of it is like this. If you're going to need more expenses in the beginning as you're growing a business. And the more you put into it, the more that those expenses will carry over time. So let me give you an example. If I hire a customer service rep today, it's because I need a customer service rep. The great news is that customer service rep can maybe help 200 extra customers. So that means as I make sales to my next 200 customers, my expense doesn't go up. The money that I'm spending to actually be able to pay for that doesn't go up because that person, or maybe even not it's a person, maybe it's a computer. Let's look at it as it's a computer. Maybe that automation that I bought can help me through 200 customers. So in the beginning when I buy it, my margins are smaller because again, what's happening is I bought that piece of equipment to manage those 200 customers. But as I sell the next 50, 100, 150 customers, well, then I get more efficient because what I paid for in the beginning will carry me through the coverage of those 200 customers. The bottom line is, as you're building a business, a lot of your expenses and a lot of your costs a lot of these ratios are out of whack at the beginning because you're putting money in that over time will help you. So as the business continues to grow, those expenses don't necessarily grow. You did them once. Now they will cover you over a period of time so you don't have to keep paying for that every single month, for example. So hopefully I didn't just make it more confusing. This equation is operating expenses divided by your net sales. So analysts love trends for good reason because reviewing comparable time periods, years, quarters, you can hone in on what's making a business profitable or causing a loss. So seeing a trend can provide you with the opportunity to correct things before they worsen, or you can do more of what's helping your business succeed. Here's why you need P&Ls. Ultimately, you need to look at what's going on quarter to quarter, year to year, because the more that you do this, the more you can spot these trends, and the more you can spot a really bad trend of unnecessary expenses climbing, for example, or the more you can spot a really good trend of operational efficiency that you want to focus more in on to be able to get even better margins, even more profit in your business. So the power of knowing your numbers is vital to running a profitable business. And I got to tell you, I can't tell you how important this is. There's so many people out there that run businesses that think they're profitable and they're not, and they don't know why because they haven't had to read P&L statements. And I have somebody that I know that was like that. He literally, the business was losing $30,000 a month, and he thought they were profitable. And the reason he thought they were profitable was he wasn't looking at the P&L. And what the P&L would have shown him was, yes, you're making the sales, but your customers aren't paying the payments. They're defaulting. And because the customers were defaulting on the payments, he was losing money and didn't realize it because his whole focus was on getting sales in the door. And the idea was, if I get sales in the door, I'll make a bunch of profit. Well, you can get sales in the doors, but if your customers stop paying you, then obviously you're not going to make the profits. Well, without monitoring P&Ls and these type of things, all this type of stuff can happen, where expenses climb without you knowing about it, and you don't know why you're making money, not making money until you look at the P&L, and then all of a sudden you realize. So it really comes down to running a profitable business. And if you don't know some of these things, even the basics, the very basics we talked about in the beginning, then it can help you create a business that you're actually coming in and making sales, but maybe not making a profit. So let's be honest, it's the profits that you take home. It's the profits that you're using to support your family. So you can make any necessary adjustments to show a profit. Numbers do not lie, which is why investors look at them when they're looking at investing or even buying your business. They'll really tell everything about the health of your business. So knowing your numbers means you have a huge advantage over those who don't. Your profit loss statement tells that story of your business. And I can't tell you this enough. Yes, you have a huge advantage, because when you look at P&L statements and you look at this trending data, then all of a sudden you're able to spot expenses you can cut. You're able to spot things that you're probably paying too much for, and you can renegotiate and pay less. Well, if that's the case and you have a competitor and the competitor's not doing that, well, they're still paying the inflated value on their expenses. They're still paying more for things than they should be, because they never had the sense to look at P&Ls, look at the trending data, know there are things that should be addressed, and go in and address them. So it gives you a huge competitive advantage, because it really tells you the story of how your business is doing. So understanding the story behind your numbers really becomes extremely important for achieving success. And success to me is a profitable business. It's a business that doesn't just generate revenue, but it puts money in your pocket that you're able to take home to your family every single night. So how to make a P&L? Well, know your numbers. Put together revenue, fixed and variable costs. Remember, the revenue is the money coming in. Fixed costs are rent, things like that that don't change. Variable costs are things like marketing and advertising that do change. Take taxes and your COGS, your cost of goods, the cost of goods to produce that item into consideration to really get to what you're really making. Several P&L forms are online to help. There's a lot of different places and ways that you can get those. And again, if you have any questions along the way that we can ever help with, let us know, 877-600-2487, info@creditsuite.com. But again, accountants and bookkeepers can help tremendously with this. Even if you're in a startup phase, okay? One of my buddies owns a company called Kahuna Accounting, and it's pretty cool. They have like their logo is like this guy surfing this wave, and there's a whole story behind that. But they helped us in the beginning stages, because they let you outsource your bookkeeping, outsource your actual financial service. And I'm not here to promote them. I'm just using them as an example, because there's a lot of companies out like them that can actually help you outsource your bookkeeping, outsource your accounting, so you get regular P&L statements. You get this information sent to you regularly. I just showed you how to read a P&L. Not how to create one if you want to create it, but if you're having a bookkeeper or accounting person do it, now I've just showed you how to actually read them and determine what you need to do based on the information in it. But make sure you get these on a regular basis, because even if you're not applying for a loan sometime soon, which they're crucial if you are, then it still helps you to know the health of the business, know what to correct, so you have more profits. More profits means more money in your pocket, more money to invest in growth, the faster you can grow. So if you don't want to construct these, well, go online. Work with the company that you can even outsource the work to that will do it for you without needing to hire a full-time bookkeeper or accounting person in your business. And in doing so, you're able to get the numbers you want on the profit and loss. Use this training to learn how to read the profit and loss, how to navigate it, how to understand it without having to do the physical work of putting it together. The great thing about this training is now you know how to put it together. You know exactly how to figure out every important ratio, every important expense or every important margin that you need to know. We went through it all. So whether you're constructing your own or having somebody else do it for you, and they're just getting the information to you so you can actually digest it, make sure you get this stuff. The biggest businesses that fail is because they don't know their numbers. By you knowing your numbers, even as a startup, it gives you a great amount of control that other businesses that don't know their numbers just don't have. We can help you anywhere along the way when it comes to getting business loans, business credit lines, building business credit for your EIN that's not linked to your social, and condensing years of trying to do that into just months. Give us a ring. That's what we're here for. 877-600-2487, info@creditsuite.com. Thanks, everybody. Have a great day.